Hello, everyone. I see you early. One small piece of financial insight every day, so you can see a little farther. Right now, a lot of investors are in a strange state. They're sitting on cash on the sidelines, watching the stock market swing up and down, completely torn inside. They're scared to buy at the mountaintop, but they're also scared of staying out and missing the only wealth train of their lifetime. And while the noise and hesitation keep getting louder, a famous bull on Wall Street has thrown a jolt into the crowd, an opinion that really forces you to stop and think. He told us that even if we've just lived through turmoil, even if there's still haze in front of us, we are actually in the early stage of a brand new bull market. And this bull market is not just a brief flash. In his view, it will be a 10-year supercycle, and the finish line could be as far away as 2035. The person making this bold call is Tom Lee, co-founder of Fundstrat. If you follow the U.S. stock market, you've almost certainly heard his name. Some people even call him a dead bull, because he's almost always leaning bullish. But if you really dig into his analytical framework, you'll realize it isn't blind optimism. It's built on a kind of cold, data-driven rationality. Before we officially take apart his logic, I want to align the timeline with you, because this matters a lot. The 10-year supercycle to 2035 forecast I'm talking about came from an interview originally published on the 29th of August 2025. At that time, the S&P 500 was around 6,489. Now it's mid-December 2025, just a little over 3 months later, and the S&P 500 is already hovering around 6,800. In just a few hundred points, the market has given an early confirmation of his bullish direction. But please understand, I pulled up this report today and read it carefully, and this is absolutely not telling you to look at 6,800 and blindly go all in with your entire portfolio. This is not telling you to chase green candles and panic sell red ones. If all you do is stare at these few hundred points of short-term ups and downs, then this whole video won't mean much to you. What we're doing today is stepping outside the short-term K-line fluctuations. Because if Tom Lee is right, if this really is a huge cycle lasting all the way to 2035, then whether the market is at 6,489 or 6,800 is basically just the scenery at the foot of the mountain. So, the true goal today is to understand the underlying logic behind his 10-year view. Only by understanding that logic can you understand why, in the previous Garcia cycle, his bullish backbone was still so strong, why he says demographics are destiny. And once you truly understand these things, then for the next long 10 years, whether the market pulls back to 5,000 or surges to 10,000, you can still hold high-quality assets in your hands and build your own investment beliefs. This isn't just repeating a market opinion. This is a study of how we perceive cycles, how we recognize wealth, and how we read the deep current of an era. To understand Tom Lee's 2035 forecast, we first have to understand the cornerstone of his framework: demographic structure. I know that sounds like a boring sociology class, but trust me, this might be one of the most valuable money lessons you can learn about financial markets. On Wall Street, most analysts obsess over the next quarterly earnings report or the next Fed meeting. Tom is looking at something bigger. He's looking at people more precisely, the human life cycle. He has a famous line: almost every long bull run since 1890 can be explained by demographics. The logic is actually very simple, so simple it almost feels obvious. Think about it. At what age does an ordinary person contribute the most to the economy? It's definitely not when you're 20 and just graduated, renting a place, paying off student loans, and basically living with empty pockets. It's also not when you're 70 and already retired, trying to save and defend what you have. The real golden consumption period and the golden investment period is usually between ages 35 and 50. At that stage, you're most likely buying a house, buying a car, having a baby. You're not just spending for yourself, you're spending for a family. Your income is often hitting the peak of your career. At the same time, You're paying for elders and for your children's education, and you start saving aggressively into retirement accounts and pension plans. When the population aged 35-50 reaches its peak, the stock market often enters a major bull market, and in reverse, when the main force gets older and the next generation hasn't fully connected yet, the market can fall into a long winter. Let's rewind to the end of the last century and test this theory. 1999 was like a celebration of the baby boomer dynasty. If you lived through U.S. stocks in 1999, you remember the almost crazy optimism. That was the peak of the dot-com bubble. The S&P 500 and the Nasdaq kept smashing new highs. People usually explain it as the frenzy created by technological progress, but Tom Lee looked through the surface and saw the essence. It was the American baby boomer generation hitting the highlight of life. This group, born after World War II, was the largest population cohort in U.S. history, and it became an incredibly wealthy generation. By 1999, they were right in their 42nd to early 52nd. They held the core wealth of society. Their desire to consume was extremely strong, and they poured a steady stream of wages into the stock market. That was the moment when the demographic dividend exploded most violently, and it helped push the market toward its historic peak at the time. Then came 2000 to 2013, the quiet rise of Generation X, and what people call the lost decade. After 2000, U.S. stocks went through more than 10 years of shocks and downturns. One key factor was that the baby boomers were a generation older and began pulling money out as they moved toward retirement. Meanwhile, the next generation, Gen X, born roughly between 1965 and 1980, was simply too small. They worked hard, but on a population scale, they were like a valley between two mountains. They weren't enough to fill the huge funding and investment gap left behind by the boomers. It wasn't until around 2018, when Gen X had fully entered their wealth peak, that the market saw a decent wave of performance again, but it still lacked that explosive, destructive power of a full demographic surge. So where are we now? Tom Lee says we're standing at the doorway of a new era, because a generation even larger than the baby boomers has finally grown up. The millennials, the Qianxi generation. For years, the media slapped labels on them: the beat generation, the moonlight people who only know how to buy expensive avocados, a generation that can't even afford toast. But the data doesn't lie, and stereotypes are being shattered by reality. Now, the oldest millennials are already in their early 42nd, and the youngest are nearly 30. Those former kids are getting married and having children, buying houses, and entering the golden age of investing through 401 accounts. According to demographic models, millennials as a whole will reach their absolute peak in career income, spending power, and wealth accumulation around 2035. And that means that in the next 10 years, the U.S. economy could enter a major golden age, a surge in the labor force, not just in supply, but in terrifying buying power. Imagine tens of millions of young people with massive mortgage needs, upgraded consumption demand, and the need to allocate money for retirement. Demand for stocks could explode over the next decade. This is what you could call a structural SF Express tailwind. And this bull market has another super fuel that didn't exist at this scale a generation ago: wealth inheritance. We are about to witness the largest wealth transfer in human history. It's estimated that over the next 20 years, roughly $84 trillion of wealth accumulated by the baby boomer generation will be inherited and shift toward millennials and Gen Z. That introduces a crucial variable. Where does young people's money go? Older generations might prefer bonds, bank deposits, or gold. But young people who grew up in the digital age have a very different risk appetite. Tom Lee's research suggests they lean more toward allocating to equities, trust technology companies more, and are more willing to embrace risk. So when massive inherited wealth meets a generation that is already entering a rising income phase and is the most willing to invest in stocks, this isn't just a trend. It's a hurricane. Tom Lee believes this demographic dividend is an unstoppable torrent of history, stronger than any short-term rate hike, stronger than any short-term geopolitical conflict. And history also tells us that the top of a bull market often coincides with the peak of a generation. If the millennial peak is in 2035, then the end of this bull market is also highly likely to be around 2035. This is not a story about a few months. This is a 10-year grand narrative, and where we are right now may only be the prologue to a long epic. But if the outlook is so bright, why is the market still full of worry? Why don't people dare to believe a bull market has arrived? This leads to the second pillar of Tom Lee's framework: fighting recent bias and understanding skepticism as a weapon the market uses. Tom often mentions recent bias, the idea that recent prejudice is simply a weakness of human nature. As investors, we're either trapped by the most recent painful memory, or we get carried away by the most recent frenzy. Think back to February 2009. At that time, the smoke of the global financial crisis had just started to clear, and the shadow of the dot-com crash still lingered. Many people swore they would never touch stocks again. Everywhere you looked, people were talking about the end of the world. But at that moment, Fundstrat turned bullish, because when everyone is bearish, when the pulse plate has dried up, that's exactly when the future opportunity is being born. The same logic applies now. We just went through a global pandemic. We lived through the highest inflation in 40 years. We experienced the Fed's most aggressive rate-hiking cycle. Investors' muscle memory is full of risk, plunges, and trauma. Tom Lee points out that current market sentiment is nowhere near what a real market top looks like. A true top needs extreme fanaticism. It needs excessive speculation like 1,999. When even taxi drivers were recommending tech stocks, and even unprofitable companies could double in a single day. But right now, Tom says the clients he meets, even institutions holding huge amounts of money, are generally skeptical. He hears it constantly. "Tom, your logic sounds perfect, but I just can't believe you, because you're always bullish." And in his eyes, that suspicion, that caution, is precisely one of the strongest long-term bullish signals. It's what he calls the power of worry. Bull markets are born in pessimism, they grow in doubt, they mature in optimism, and they die in frenzy. As long as everyone is still doubting, as long as everyone is still hesitating, the market still has a steady stream of potential buying power. All that sidelined cash, all those funds waiting and watching, will eventually be forced in because of the anxiety of missing out, and that becomes fuel that pushes the market higher. Tom Lee also offers an interesting perspective. Investing in this era requires wearing 20-year-old glasses, because the most disruptive changes in the world are often driven by young people. Whether it was the internet, smartphones, cryptocurrencies, or artificial intelligence, older generations may not understand. They may feel it's a bubble, but young people turn it into a lifestyle. They find a strut to catch the trend. And Fundstrat doesn't only stare at boring data, they spend a lot of time studying the mischievous behavior of the young. Because where young people go, money eventually follows. Now, I know what you're thinking. Demographics are great. Psychology is fascinating, but what about the macro environment? America's debt is terrifyingly high. Fed rates are still relatively high. Can the economy really hold up? This is the weapon opponents use most often. But Tom Lee has his own rebuttal. First, technology. He believes the United States is in the middle of a global storm of structural change, driven mainly by two engines, AI and blockchain. This is not a simple industrial upgrade, it's a qualitative leap in productivity. U.S. leadership in AI and exploration in blockchain are injecting unprecedented vitality into the economy. These technologies can massively raise efficiency, create new business models, and drive explosive corporate profit growth. That's why he's especially bullish on tech stocks and on parts of the financial industry that could be revalued. He even predicts that the financial sector's market cap could rise to about 40% of the S&P 500. Second, the debt to GDP problem. Everyone knows U.S. debt is high, and many fear it will squeeze the private sector's survival space. But Tom argues many people are miscalculating or missing the other side of the ledger. He points to two countervailing forces. The first is America's enormous, invisible assets. When we evaluate a company's leverage, we can't only look at what it owes, we also look at what it owns. On the U.S. government's balance sheet, many assets are severely undervalued, sometimes even recorded as zero. The national park system, huge land and resource rights, gold reserves, even the postal system. If these assets were revalued at market prices, the scale would be measured in trillions of dollars. This hidden wealth is the crushing stone that stabilizes U.S. credit. The second is the dominance of the U.S. dollar. Over the next 20 years, if the dollar maintains or even expands its global dominance, then the debt issue can be digested to a large extent. As long as the world still needs dollars, America has the ability to manage its debt. Then there's the Federal Reserve. Tom Lee calls the Fed the most powerful single entity in the world. He has high expectations for the Fed's independence. Yes, the market is always worried about policy mistakes, but he believes market forces themselves create a kind of check and balance that ultimately pushes the government to respect the Fed's professional judgment. Still, even though he can see all the way to 2035, he's not telling you to close your eyes right now, buy, and sleep. He also offers very specific risk factors and monitoring metrics. As an investor, you have to know when to retreat. Tom's high-level rule is that a market peak usually requires one of two catalysts. The first is sudden policy tightening or an external shock, for example, the Fed suddenly going crazy and tightening liquidity, like what happened in 2022, or a massive commodity shock, like oil suddenly soaring to $400 a barrel. In that kind of scenario, fundamentals can break down instantly. The second catalyst is the excessive speculation we talked about earlier, something like a nationwide 1,999 style orgy, where everyone thinks they're a stock god and nobody cares about valuations. So are there any quantitative indicators? Tom mentions the VIX Panic Index, but his use of VIX is special. He says VIX is an excellent bottom signal. Historical data shows that when VIX spikes above 60 and then falls back to close below 30, the market has often already bottomed. But please remember, this indicator does not work in reverse. A low VIX does not mean the market is about to crash. So don't look at today's calm VIX and scare yourself. Up to now, margin debt hasn't hit new highs, retail sentiment isn't out of control, and policy remains relatively stable. As long as these red lines aren't crossed, the bull market logic still holds. At the end, I want to share one personal reflection from Tom Lee, because it might be the most valuable part of today. As a strategist, Tom says the proudest moments of his career weren't about predicting the rise or fall of any single stock. It was about keeping people in the market. When the pandemic melted everything down in 2020, when the market pulled back and washed people out in April this year, when everyone panicked and wanted to clear their positions and run, he told everyone not to move, just hold. Because, in investing, the biggest tragedy isn't that your stock drops 20%. The biggest tragedy is that you cut the meat and leave the market when you're down 20%. And then you watch the market rebound to new highs while all you're left holding is a pile of cash that keeps losing value. And once you step out in panic, the psychological hurdle to get back in becomes extremely high. His core advice is actually very simple. Don't think of yourself as someone who just buys a stock. Think of yourself as someone who buys a company. When you buy a great company, you know it's changing the world. You know it has strong cash flow. Then tariffs are fine. Inflation is fine. Even Fed, gassy, And all the macro noise, none of it can shake your conviction. That's why he can look as far as 2035. It's not just a prediction of numbers. It's a deep belief in human development, in technological progress, and in the ability of high-quality assets to travel through cycles. Of course, the next 10 years won't be a straight line. We will go through pullbacks. We will experience panic. There will be countless nights that make you want to give up. But if the picture Tom Lee is painting is correct, if you can put on long-term glasses, if you can understand the rolling demographic torrent, then you might discover that right now really could be a great place to begin. Investing is a practice. May we all meet at the top of the mountain in 2035.